Hi again, students. So, welcome dito sa ating part 2 discussion for partnership dissolution. Okay, so sa ating part 1, um we're done with dun sa admission of a new partner. We have discussed purchasing of capital interest and uh, admission through investment of the new partner. Okay, so we'll proceed with the other considerations to account in or the other scenarios to account for partnership dissolution. Okay, so for this discussion, we're going to focus retirement of a partner or withdrawal of a partner, then death of a partner and incorporation of a partnership, or formation of uh, partnership or conversion of a partnership into corporation. Okay, so let's start with the retirement of a partner. Okay, for a retirement or withdrawal of a partner, the accounting consideration is to adjust the partner's capital account by the changes in the value of the assets and liabilities, then recognize profit or loss up to the date of retirement or withdrawal. So when a partner is to withdraw or retire from the partnership, okay, then the capital balances of all the partners, including the retiring partner, will be adjusted up to the date, okay, of the retirement. Also, any profits or losses must be recognized and distributed to the partners also up to the date of the retirement. So always take note of the date of the retirement because up to that date you're going to adjust the capital balances with everything that will affect the capital account of the partners. Okay, so the changes in the value of the assets and liabilities and recognition of profit or loss at to the date of withdrawal or retirement. Okay, so it involves the settlement of retiring or withdrawing partners' uh, capital interest, adjusted capital interest. So settling or settlement of the capital interest of the retiring partner depends on uh, the price agreed upon by the partners. So upon if there is a retiring partner, all the partners will agree as to the retirement price for the adjusted capital interest of the retiring partner. Okay? So the accounting depends if the retirement price or RP, let's have it RP, is equal to the retiring partner's adjusted capital interest or PASI. Okay, we have it PASI. Okay, um, accounting depends also if the retirement price is equal to the adjusted capital interest of the retiring partner, or the retirement price is not equal to the partner's capital interest or PASI. Okay, so it could be the retirement price greater than the PASI, or the retirement price is less than the PASI. Okay, so PASI short for partners adjusted capital interest. So we have considerations here. So if the retirement price is equal to PASI, no revaluation of asset needed, no goodwill to recognize, and no bonus to or from partners. However, if retirement price is not equal to the PASI or the partner's adjusted capital interest, then methods will be considered in accounting for that retirement. So if the retirement price is greater than the uh, PASI or the partner's adjusted capital interest, then three assumptions will be considered: either proportionate goodwill, full goodwill, or uh, bonus method. A bonus method will refer to remaining partner, a retiring partner. Okay, so if the retirement price is greater than the uh, partner's adjusted capital interest, bonus method, the bonus will refer to the retiring partner. However, if the retirement price is less than the partner's adjusted capital interest, only two methods is applicable: revaluation method and bonus method. The bonus method will refer to the bonus to remaining partners. Okay, so let's have first the retirement price greater than the partner's adjusted capital interest. Let's start with proportionate goodwill method. If proportionate goodwill method will be used, the difference between the retirement price and the partner's adjusted capital interest is treated as proportionate goodwill, which is an asset. The remaining partners' capital are not adjusted in the recognized goodwill. Okay? So, hindi ka magre-recognize ng goodwill sa capital account or mag-a-adjust ng goodwill sa capital account ng remaining partners. Okay? Pag full goodwill naman, the difference of the retirement price and the partner's adjusted capital interest is treated as goodwill. Okay? Treated as goodwill, which is an asset, but this time, the computed goodwill will be adjusted, will be grossed up. Okay? It will be grossed up into a full goodwill, okay, using the retiring partner's interest ratio. So later we're going to apply it in the problem solving. Then remaining partners share in the excess of full goodwill are over the computed goodwill will be recognized as respective shares as an increase in their capital. Okay? Then as to bonus method, bonus to retiring partner, the difference between the retirement price and the partner's adjusted capital interest is treated as a bonus to such retiring partner. Then the remaining partner's capital will be decreased by the bonus. Okay? But if the retirement price is less than the partner's adjusted capital interest, if revaluation method applies, the difference between the retirement price and partner's adjusted capital interest is treated as overvaluation, uh, revaluation of overvalued asset downward, not upward, only downward. Okay, so treated as again revaluation of overvalued asset. So revaluation downward. Then the overvalued asset may be decreased by allocating the amount of the difference between the retirement price and the uh, partner's adjusted capital interest. Then the remaining partner's capital is unaffected by the decrease. For bonus method naman, bonus to remaining partners, again the difference between the retirement price and the partner's adjusted capital interest is treated as a bonus, but this time to remaining partners. Then the remaining partners' capital are increased by the bonus. Okay? So let's have it in the problem solving. Retirement price is equal to partners' adjusted capital interest. So partnership of RAM, REM, and RIM has capital balances of 50,000, 65,000, and 55,000 respectively with 3 is to 5 is to 2 ratio. Ram is retiring from the partnership on August 31, 2020. So take note of this date. We need this date because we need to adjust everything up to this date. The partnership earns net profit of 5,500 per month. So given yung per month, per month, not the whole year. So per month yung 5,500 na profit. On August 31, 2020, the partnership assets and liabilities increased to 52,000 and 37,000 respectively. So yung asset daw nag-increase 52,000 at saka yung liabilities nag-increase ng 37,000. The retirement price for Ram's interest is equal to his adjusted capital interest. So therefore, retirement price equal lang sa kanyang adjusted capital interest. Okay? So to account, the computation of net increase in the capital of the partnership, increase in asset, then increase in liabilities, net increase is 15,000. Then this 15,000 will be shared by the old partners, RAM, REM, RIM. So 4,500 for RAM, 7,500 for REM, and 3,000 for RIM. Total niyan 15,000. Afterward, took effect the increase to their capital balances later. Then computation of the net profit as of August 31, 2020. Take note, we only have the monthly profit of 5,500. So from up to August 31, starting from January to August 31, we have it 8 months. So January, February, March, April, May, June, July, August. So that would be 8. So times 8, total income or net profit as of August 31 is 44,000. Okay? The distribution of net profit to RAM, REM, and RIM, okay, you're going to adjust their capital balances with the a share in the profit as of August 31. So for RAM, we have 13,200. For REM, we have 22,000. And for RIM, we have 8,800. Okay? Then adjust the capital balances with all the adjustments. Okay, so for RAM, the adjusted capital is 67,700. For REM, we have it 94,500, and for RIM, we have 66,800. Okay, so that would be the total adjusted capital balances per partner. So total is 229,000 as of August 31. Okay. Then took effect to journalize and to account the retiring of Ram, since we have to account for his retirement. We have the first journal entry to recognize the adjustment of the assets and liabilities and the capital of the partners in connection with the net increase of the net asset. So let's have a debit to identifiable asset for 52,000 and credit identifiable liabilities for 37,000. We only temporarily use these accounts, okay, because no specific accounts on assets and liabilities were given. Should there be a specific asset accounts and liabilities accounts, use them in the journalizing. But for illustration purposes, we're going to use these accounts na lang muna. Okay? Then credit RAM, REM, and RIM capital respectively for the share in the net increase. Okay? Then close. Okay? Close the um, share in the net profit as of August 31, okay, respectively to the capital of RAM, REM, and RIM. So debit income summary for 44,000, then RAM capital 13,200, REM for 22,000, and RIM for 8,800. Then the final entry is to took effect the retirement of RAM. So debit tayo kay RAM capital 67,700, then credit cash because it is agreed that he will be paid for his retirement. Then the cash payment is equal to his capital credit of 67,600. That is the agreed retirement price. So 67,600, no difference. Okay? So that's it. Very simple if no differences in the no difference in the retirement price and the retiring partners adjusted capital interest. Okay? So next problem. Retirement price is greater than the partners adjusted capital interest. So RAM is retiring from the partnership on September 30, 2020. The partnership earns profit of 6,000 per month. So per month ulit yung binigay. On September 30, the partnership assets and liabilities increased by 60 and 30,000, 60,000 and 30,000 respectively. The retirement price for RAM's interest amounted to 90,000 as agreed upon. So this time, provided yung retirement price, which is 90,000, agreed upon. Okay? So to account for the retirement, compute first for the net increase in the capital of the partnership, that would be 30,000. So 60,000 increase in asset versus the 30,000 increase in liabilities, increase in net capital is 30,000. So the 30,000 will be shared or distributed by the partners respectively on their account and ratio 9,000, 15,000, and 6,000 respectively to RAM, REM, and RIM. Okay? Then compute the profit as of September 30, 2020. So monthly profit of 6,000 times 9 months coverage. So total of 54,000. Then distribute this 54,000 to RAM, REM, and RIM. That would be 16,200 for RAM, 27,000 for REM, and 10,800 for RIM. Okay? Then adjust the capital balances of each partner based on the net adjustment that will be taken effect for each capital accounts. Okay? So for RAM, we have 75,200. For REM, we have 107,000. And for RIM, we have 71,800. Okay? In all, we have it 254,000 as of September 30, 2020. Okay. Then, to journalize the transaction, okay? To journalize the transaction, yan. Debit tayo ng identifiable assets and credit identifiable liabilities for purposes of this illustration since wala namang given na specific accounts. 60,000 for identifiable assets and 30,000 for liabilities. Then credit RAM, REM, and RIM capital for the respective share in the net increase, 9,000, 15,000, and 60,000. Then debit income summary for 54,000 for the so to took effect the distribution of the 54,000 net profit as of the date of retirement. So credit RAM, REM, and RIM capital for 16,200, 27,000, and 10,800 respectively. Okay, so that was our initial journal entries for adjustment of capital balances of each partner. Now, to took effect the retirement, if we choose to have it as proportionate goodwill method, then the computation of the proportionate goodwill, okay, what is said earlier is that it is the difference of the retirement price and the adjusted capital interest of the retiring partner. So the retirement price is 90,000 versus the adjusted capital interest of 75,200 of RAM. That would be a 14,800 difference will be goodwill. Since it is a proportionate goodwill method, okay, we're going to recognize this goodwill in the partnership book, but the old partners will not consider sharing in this goodwill. Okay, so the old partners capital accounts will be remain will remain unchanged uh, despite the recognition of the goodwill. So to journalize the retirement, we debit RAM capital of 75,200, then credit tayo ng cash for the agreed retirement price. Then the difference, recognized goodwill of 14,800. Again, this goodwill will effect uh, as a recognized asset only, but will not increase, okay, will not increase the capital balances of will not increase the capital balances of the remaining partners. Okay? If we have it full goodwill method, okay, this time mag-share na po sa excess yung uh, remaining partners. Okay? So the computation of the full goodwill, retirement price of 90,000, RAM's adjusted capital interest of 75,200, then again, this 14,800 earlier is a proportionate goodwill. To compute the full goodwill, we have to gross this up using the RAM's interest ratio of 30%. So the full goodwill is 49,333 rounded off. So the computation of excess goodwill, so the full goodwill of 49,333 versus the proportionate goodwill of 14,800, the excess is 34,533. This will be the amount in which the remaining partners will share. Okay? Whew. So the distribution of the excess goodwill to REM and RIM, the remaining partners, we're going to make use of their old capital interest of in accordance with 3 is to 5 is to 2. So the remaining interest there is the 5 and 2 for REM and RIM. So total that 7, make a fraction 5 over 7 and 2 over 7, or 71.43 for REM and 28.57 for RIM. So distribute the excess For REM, we have 24,667, and for RIM, we have 9,866. Then, journalized day, retirement. So, debit tayo RAM capital for 75,200. Then, debit tayo ng full goodwill. Ayan, 49,333. Debit here the full goodwill. Then credit cash for 90,000 for the retirement price of RAM's capital interest. Okay. Then credit the respective capital account of REM and RIM for the share in the excess goodwill. Okay. So that's it. Last is bonus method. Okay. So what if bonus method will be assumed? So the computation of bonus to RAM, okay, since retirement price is greater than the adjusted capital interest of RAM, expect that the bonus is a bonus to RAM. Okay, the old partners will be giving bonus to RAM. So retirement price 90,000 versus adjusted capital interest of RAM is the difference is 14,800 bonus to RAM. Then the respective remaining partner will share in the bonus to RAM. Okay, they will be decreased with a specific amount. So based on their capital interest on the ratio 3 is to 5 is to 2, earlier we have a competition based on the 5 is to 2, so make use of that. So 5 over 7 and 2 over 7, or 71.43% and 28.57%. So for REM, we have 10,571, and for RIM, we have 4,229. Okay? So took effect in the journal entry the retirement of RAM, debit RAM for 75,200 RAM capital, then RIM capital and REM capital and RIM capital for the respective share in the bonus to RAM. 10,571 for REM and 4,229 for RIM. Then credit cash for 90,000 for the retirement price, agreed retirement price of RAM's interest, adjusted capital interest. Okay. Next, retirement price of a partner, a retirement price. Retirement of a partner, retirement price is less than partner's adjusted capital interest. So, RAM is retiring from the partnership on July 1, 2020. The partnership earns profit 8,500 per month. On July 1, 2020, the partnership net assets are overvalued due to a failure to recognize 9,500 bad debts on accounts receivable. So naging overvalued daw yung asset natin because hindi tayo nakapag-recognize ng isang contra asset na 9,500 on accounts receivable. The retirement price is 55,800 as agreed upon. So RAM's interest will be paid for 55,800 as agreed upon. So the computation of the net profit as of July 1, 2020. So net profit of 8,500 per month times 6. So that would be 51,000. The distribution of the net profit would be RAM 15,300, for REM 25,500, and for RIM 10,200. Okay? Then adjust the capital balances of the partners. Only the share in the net profit will be taken effect, the adjustment. So for RAM, 65,300, for REM, 90,500, and for RIM, 65,200. Okay? Then took effect in the journal entry, the retirement. So debit income summary for 51,000. To took effect the distribution of the net income as of July 1. Then credit the capital accounts of RAM, REM, and RIM for the share in the 51,000 net income as of net profit as of July 1. So 15,300 25,500 and 10,200 respectively. Then journalize the retirement, debit RAM capital for 65,300, then credit cash for the debit cash for the agreed retirement price of 55,800, and the difference will be the over will refer on the over valuation. The difference of the retirement price and uh, the difference of the retirement price and the adjusted capital interest of RAM will be accounted for as ano as um, referring to the overvaluation. So therefore, we have to set up a bad debt account for accounts receivable of 9,500, which was stated earlier. Okay. So another example, Ram is retiring from the partnership on November 1, 2020. The partnership earns profit of 9,000 per month. So the retirement price of Ram's interest is amounted to 70,000 as agreed upon. So the computation of net profit as of November 1, that would be November 1. Yeah, November 1. So 9,000 monthly profit times 10, that would be 90,000. Then distribute 90,000 to RAM, REM, and RIM. RAM 27,000, REM 45,000, and RIM 18,000. Then adjust the capital balances. RAM we have 77,000, REM we have 110,000, and RIM 73,000. Okay? Then have it in the then computation of bonus to REM and RIM. Okay. So this should be a yeah. So computation of bonus to REM and RIM, retirement price will be 70. So RAM's adjusted interest is 77. Okay, then bonus to remaining partners. So bonus method will be assumed here. So bonus method, bonus to remaining partners 7,000. Then REM and RIM will share in the bonus 7,000. So for REM 5,000 and for RIM 2,000. Then took effect the retirement debit income summary for 90,000. Credit the respective capital accounts of the partners for the respective shares in the profit. So 27,000, 45,000, and 18,000 respectively to RAM, REM, and RIM. Then took effect the retirement, RAM capital debit 77,000, then credit cash for 70. Then the excess or the difference between the two will be credited to capital accounts of REM and RIM as bonuses. Okay? Next, death of a partner. So, death of a partner, if there is a sudden death of a partner, the accounting consideration is that the deceased partner's capital account is adjusted with the following up to the date of his death. So, consider adjusting everything up to the date of his death. Changes in the value of the assets and liabilities up to the date of death, and share in the net profit or loss as of the date of death. The adjustment is due to the changes. The adjustment due to the changes in assets and liabilities, also in the net profit, may be accounted also in full depending on the method agreed upon by the partners. Earlier, the method would be termed as proportionate method. Here we can have as full accounting or full method. Okay, partners may agree to adjust the deceased partner's uh, capital capital balance, okay, only up to the date of his death, or full accounting up to the end of the uh, reporting period. So let's have in the problem solving later. The deceased partner's capital adjusted capital account is reclassified into a liability pending for settlement, then the estate of the deceased partner is entitled for the settlement. So after adjusting the capital account of the deceased partner, i-reclassify daw into a liability account pending for settlement. Then upon settlement, the estate of the deceased partner will be receiving. When we say estate, the surviving, okay, person of the retiree deceased partner. Okay? So death of a partner, ayan. So partnership of RAM, REM, and RIM, 50,000, 65,000, and 55,000 capital balances. 3 is to 5 is to 2 capital ratio, and the partnership earns net profit of 6,000 every month. Due to health problems, REM died on October 31, 2020. Devastated with his death, the remaining partners promised that the family of REM to settle his interest in the partnership. Um, then the following information were made available. Increase in the net asset up to the date of REM's death, 30,000. Increase in the net asset, increase in the asset rather, for the current year, so full increase of 50,000. Increase in liabilities up to the date of REM's death, 10,000. Then increase in liabilities in full for the current year, 20,000. So we're going to have here a proportionate method and full accounting method. So up to the date of death of REM, so proportionate method, to compute the net increase in the capital up to the date of REM's death, increase in asset 30,000, increase in liabilities 10,000. So net increase of 20,000. Ito yan. Itong dalawa, itong 30,000 at saka itong 10,000 lang up to the date of the REM's death. So net increase of 20,000, then adjust everything. RAM, REM, and REM's capital will be increased with the respective share of the 20,000 net increase. 6,000 for RAM, 10,000 for REM, and 4,000 for REM. Okay? Then computation of the net profit as of October 31, 2020, monthly profit of 6,000 times the month coverage of 10 months, so 60,000 yan. So adjust again RAM, REM, and REM's capital for the respective share. So 18,000 for RAM, 30,000 for REM, and 12,000 for REM. So adjust the capital balances up to the date of REM's death. So for RAM, 74,000, for REM, 105,000, and for REM, 71,000. Then this 105,000 will be reclassified into a liability account. So to do that, debit, let's look at everything in the journal entry. Debit identifiable assets for the increase in the 30,000. Credit identifiable liabilities for the net increase in 10,000. Then credit capital accounts for the respective share in the net increase. Okay? Then debit income summary for 60,000 for the amount of profit as of the date of death of REM in the October 31. Then credit RAM, REM, and REM for the share in the net profit. 18,000, 30,000, and 12,000 respectively. Then to reclassify the capital account of REM into a liability account, debit the capital of REM, then credit payable to REM's estate. So we'll make a specialized account title for this one. So for illustration purposes, we'll make use of payable to REM's estate. This would be presented as a liability of the partnership to the estate of REM. So good for 105,000. What if we're going to make use of the full accounting? So full accounting up to the end of December 2020, December 31, 2020. So we'll make use of the full increase in the assets and liabilities. So 50,000 and 20,000, net increase is 30. So distribute it to RAM, REM, and REM. 9,000 for RAM, 15,000 for REM, and 6,000 for REM. Okay? Then profit for 2020, monthly profit of 6,000, months coverage, full accounting, so times 12 months, so 72,000. Distribute also So 21,600 for RAM, 36,000 for REM, and 14,400 for RIM. Then adjust the capital balances. RAM is 80,600, REM is 116,000, and for RIM 75,400. Then journalize everything. Ayan. Identifiable assets, full increase, 50,000. Identifiable liabilities, for full increase of 20,000. Then the respective share in the net increase of 30,000. 9,000, 15,000, and 6,000 respectively to RAM, REM, and RIM. Then debit income summary for 72,000 for the full profit. Then distribute this one, credit to the capital accounts of the partners for the share in the net profit distribution. So RAM, REM, and RIM, 21,600, 36,000, 36,000, and 14,400 respectively. Then to reclassify the capital account of REM to a payable account. So debit REM capital 116,000 and credit payable to REM's estate 116,000. Okay. Then last is incorporation of a partnership. So incorporation of a partnership, conversion of a partnership into a corporation. So conversion of a partnership into a corporation, the accounting consideration is that the partners may agree of the conversion of the partnership, okay, by using the concept that we have in the previous discussion. Partnership book will be retained and be created as a new corporate book or create a new corporate book. Parang the same lang doon sa when we have the partnership formation. Okay? So again, partnership book as the new corporate book or create a new corporate book. So partnership book as the new corporate book, assets and liabilities shall be revalued to the current fair value. Partners must agree to the par value, yung tinatawag na par value of the shares of the corporation. Don't worry, par value will be given. Okay? Then last is to close the partners' capital accounts to the corporate capital accounts. Okay? If the assumption is to create a new corporate book, again, assets and liabilities shall be revalued to their current fair value. Partners must agree to the par value of the shares of the corporation. Par value again will be provided. Close the partners' capital accounts to the corporate capital accounts. Then the additional considerations is we have to record the transfer of assets and liabilities to the new corporate book and to record the distribution of capital stock to the partners in settlement of their capital interest. Okay? So let's have an illustration. RAM, REM, and RIM, capital balances of 50, 65, and 55,000. Profit or loss ratios 3 to 5 is to 2. On December 31, 2020, the partners agreed to convert the partnership into a corporation, okay, with an authorized with an authorization to issue shares, ordinary shares of 100,000 shares with par value of 10. Okay? So 12,840 shares were issued at 25 peso per share. Medyo hindi nyo to magigets ng konti, pero just follow me on how we're going to solve and account for this problem. Okay? To continue, the following information were made available. Yung cash, 50,000, accounts receivable, 90,000, other asset, 110,000. Accounts payable, 30,000, and notes payable, 50,000. Then they have the following agreement. Bad debts on accounts receivable 10%, increase in the value of other asset to plus 70,000. Accrued expenses must be recognized 10,000 and goodwill 100,000 must be recognized. Then the issuance of 12,840 shares in accordance with partners adjusted capital balances. So how are we going to account for all of this? Let's have first the first assumption. Partnership book as the new corporate book. So to adjust the assets of the uh, wait, I guess that must be assets and liabilities. To adjust the assets and liabilities at the current fair values, so book value for cash 50,000, wala na mga adjustments, so fair value 50,000 pa rin. Accounts receivable 90,000. Okay? Magka-credit tayo ng accounts receivable because of a 10% due for uh, excuse for a while. This should be 10%. So the accounts receivable will be adjusted, deducted with 9,000, computation of the 9,000. 90,000 times 10%, okay, due to the agreement that we have earlier. So this will be decreased to fair value of 81,000. Other asset will be increased with 70,000. So 110,000 plus 70,000, we have 180. Accounts payable, no adjustment. Notes payable, no adjustment. Then recognize goodwill for 100,000. Then recognize accrued expenses for 10,000. Okay, so net adjustment 151,000, 170,000 plus 151,000. Total net adjustment is 321,000. So the distribution of 151,000 net adjustment to the capital of RAM, REM, and RIM, yan, 45,300 for RAM, 75,500 for REM, and 30,200 for RIM. Then to adjust the capital of RAM, REM, and RIM, 95,300 for RAM, 140,500 for REM, and 85,200 for RIM. Okay? So this adjustment will be used later. Adjusted capital will be used later for the issuance of the shares based on adjusted capital balances. So the analysis of issuance of 12,840, okay, issue price of the shares of the 12,840 shares times the 25,000 issue price per share will be 321,000. Par value of the 12,840 shares, so times 10 pesos per share, so 128,400. So the difference is a premium on share issuance. So the distribution of 12,840 shares to RAM, REM, and RIM, so 95,300 divided by 25,000, that would be 3,812 for RAM. For REM, that would be 5,620. Then for RIM, we have it 3,408, a total of 12,840. Okay. So to record the conversion, adjust the other assets, debit for 70,000, recognize goodwill for 100,000, credit bad debts, accounts receivable 9,000, credit accrued expenses for 10,000, then the respective share in the net adjustment. Okay? 45,300, 75,500, and 30,200 respectively for RAM, REM, and RIM. Then took effect the conversion by closing the partner's capital account to the corporate capital account. The corporate capital account will have the ordinary share capital mainly and the additional capital for the excess. Okay, so the 9,000 95,300, 140,500, and 85,200 respectively to RAM, REM, and RIM will be credited in total ng dalawang to. So, yung ordinary share capital, yung 128,400 kanina sa competition, yung par value, then yung excess na 192,600, yan yung premium. Okay? So, yan yung ating journal entry. Yung total nitong tatlo, total nitong dalawa. So, equal pa rin yan. Assumption 2 is to create a new corporate book. If we have to create a new corporate book, meron lang tayong additional journal entry dyan. Okay? Yung additional journal entry natin later, i-reveal. So, the same journal entry in adjusting the assets and liabilities and adjusting the capital balances of each partner in recognition for the adjustments. Then, eto na. Okay? Close the account, the partnership book. Okay? Yung all liabilities and capital, adjusted capital amounts, i-debit lahat yan. Then yung assets, in adjusted amounts, ipang-credit yan. I-credit lahat. Then, ayan na. Took effect the conversion of the partnership by recognizing the assets in the new corporate book, debiting the assets, and crediting the contra assets and other liabilities, okay, to the new corporate book, and re-entering the new corporate capital. Ordinary share capital at par value 128,400 and additional paid-in capital 192,600. Okay, so take note of the difference in the journal entries. So I guess that's it for our partnership dissolution. So tapos na ako sa part 1, tapos na rin ako sa part 2. So next is partnership liquidation. So stay tuned for our pre-recorded video lecture. Okay?